Welcome to this second mini lecture in Chapter 10, and we're going to be finishing up Learning Outcome 10-2. We left off with payroll tax liabilities, and we're going to pick up with accrued income taxes. Again, if you remember the accounting equation, just a review of the rules of debit and credit. Assets are on the left side of the accounting equation, so we increase on the left or debit side. Liabilities and equity are on the right side of the accounting equation, so we increase on the right or the credit side, and to decrease, we do just the opposite. Okay, taking a look at accrued income taxes, you actually learned how to do this accrual entry back in Chapter 4 when we did our adjusting entries, but this tells us a little bit more about how we do that calculation. First of all, the tax return is number 1120. That's the corporate tax return. And it's similar to the income statement except that it calculates taxable income by subtracting tax allowed expenses from revenues. And then we take the income, taxable income, and multiply it by a tax rate which ranges between 15 and 35%. Corporate income taxes are due 2.5 months after the end of the year, although most corporations are required to pay taxes in advance installments during the year. And if you remember, our journal entry to accrue income tax is a debit to income tax expense and a credit to income tax payable. Okay, now let's take a look at notes payable. And notes payable is really the flip side of notes receivable. We're talking about a promissory note, a written promise to pay principal plus interest at a future date. Now we're going to be talking about short-term notes payable in this lecture, which is notes that are due 1 year or less into the future. So notes payable represents the amounts the company owes to others as a result of issuing promissory notes. It's the flip side of notes receivable transactions, and with short-term notes, principal and interest are due at maturity, which is the day that the note is due, and we use the same interest calculation formula, principal times rate times time. That gives us interest expense. Let's flip to the next page. And just like with notes receivable, there are 4 key events. First of all, to establish the notes. And in this chapter, all the notes that we're going to be looking at are notes that arise because we're borrowing money. So when we borrow money, we receive cash, so we debit cash, and we credit notes payable. That was for the $100,000 loan that we created by signing a 1-year 6% note. Now note that we don't record any interest on the day that the note is made. That's because interest accrues or accumulates over time. On the day the note is made and the loan is received, we simply debit what we're receiving here, cash, and we credit notes payable to increase the liability. Normally, you would accrue or record interest on a monthly basis when you're doing your financial statements, but as I mentioned in these problems, they seem to have lazy accountants who don't accrue interest until year end, and in this case, year end is December 31st. So to calculate interest, we multiply the principal, $100,000, times the 6% annual rate of interest, and then we multiply by the fraction of the year that is passed since we borrowed the money. That's all of November through all of December, 2 months. And we multiply then by 2/12. When we're talking about notes that are expressed in terms of months, the denominator to your fraction will always be 12 because there are 12 months in a year. And by multiplying the interest rate by the fraction of the year that the note covers at this point, the amount of time that you've borrowed the money for at this point, then that converts that annual rate to a 2-month rate, so to speak. So that gives us $1,000. We debit interest expense and credit interest payable. Now on the day that the note is due, if we still have that lazy accountant who has not recorded any interest at all throughout the course of the year, we're going to have to record interest from December 31st, 2015 to November 1st, 2016. And that's 10 months worth of interest. So, first of all, let's figure out how much interest we owe for those 10 months from January 1st to November 1st. We would multiply $100,000, the principal, times the interest rate, 6%, times 10 months divided by 12, that's $5,000 worth of interest. We would also be paying off this interest payable that we recorded for last year's interest. So last year's interest, $1,000, plus this year's interest, $5,000, equals the total interest that we owe, $6,000. And make sure you double check that by multiplying $100,000 times 6% times a full year's worth of interest. That's 12/12, the length of the note. And that does indeed confirm the fact that we should be getting paid, we should be paying $6,000 worth of interest. Okay, so on November 1st, you're recording the payment of a full year's worth of interest. $1,000 of it was recorded as an expense last year, and $5,000 is recorded as an expense this year. Remember, we have to split the interest up between the 2 years because we want to make sure the interest expense gets into the correct year. Then we record the payment of the note. So we take this notes payable that we originally credited, and when we pay it off, we reduce liabilities by debiting them. So we debit notes payable and we credit cash. The opposite of when we establish the note. Okay, let's try a problem. We're going to be working on problem E10-2. And in this problem it says that many businesses borrow money during periods of increased business activity to finance inventory and accounts receivable. For example, Mattel builds up its inventory to meet the needs of retailers selling to Christmas shoppers. A large portion of Mattel's sales are on credit, and as a result, Mattel often collects cash from its sales several months after Christmas. So from the time they build up the inventory in making products and then sell them and then finally collect, it could be several months down the road. And what does Mattel use to pay its own bills? Well, they might need to borrow some money to cover that. So assume November 1st, 2018, Mattel borrowed $6 million in cash from Metropolitan Bank and signed a promissory note that matures in 6 months. So they're going to pay it off in 6 months. So that's a short-term note, 1 year or less in length. So on, November 1st, Mattel is going to be receiving cash. So we'll debit to increase the asset cash for $6 million. And we'll credit to increase the liability, note payable, short term. And again, it's short term because it's a year or less in length. $6 million. We record no interest expense yet because no time has passed yet. Now let's say it's December 31st, the end of the fiscal year, and we have not recorded any interest expense yet. So we need to make sure we record the interest that we owe for borrowing this money for 2 months, all of November and all of December. Our debit will be to interest expense, and our credit will be to interest payable, because we're not going to pay it yet. We're going to pay it when the note becomes due on its maturity date. The way we calculate the amount is we multiply $6 million, the principal, times the interest rate of 8%, times how many months have passed. Well, all of November, all of December, that's 2 months, divided by 12. And the amount of interest Mattel owes is $80,000 as of December 31st. By doing this adjusting journal entry, that puts the expense for borrowing the money in the correct year, and it records the payable on the balance sheet. Now, May 1st, when the principal and interest become due, we're going to pay all of the interest as well as the principal back. Now, instead of doing our journal entry in 2 parts the way we have here, I'm going to collapse that into 1 journal entry. In other words, we're going to have 3 debits. We're going to have a debit for the interest payable that we recorded for last year's interest, a debit for interest expense, and then a debit to notes payable. And then we'll be doing 1 great big credit to cash for both. So let's do that now. Let's debit this notes payable, because we're going to be paying off the principal, and that will reduce the liability. So that credit we're going to debit here. And then we'll also be paying off this interest payable, the interest from last year. So debit both payables. And now we have to record interest expense for this year. So we'll debit interest expense, and I'll show you the calculation for that. We multiply $6 million times 8% times how many months have passed? Well, all of January, February, March, and April, that's 4 months, divided by 12. And that gives us $160,000. And then we will do a great big credit to cash for the addition of all of these 3. $6,240,000. Now, if you want, you can also calculate how much interest expense should be paid in cash for that date, and that would be interest for the full 6 months. And you can double check that $240,000 worth of interest by multiplying 6 million times 8% times 6/12, and that will verify that you should be paying in cash $240,000 worth, or 6 months worth of interest. Now, there's going to be one more topic I'd like to deal with before we finish Learning Outcome 10-2, and that deals with sales tax payable. Now, sales tax is something we're very familiar with in New York, right? Because other than unprepared food and medications, we pay sales tax on just about everything. And because sales tax has to be collected by sellers and then remitted to the state, definitely within a year, usually much more frequently than that, it's considered a short-term liability. Now, it says here retail companies are required to charge sales tax in most states, excluding the few we see here: Delaware, Montana, New Hampshire, and Oregon. Retailers collect sales tax from consumers at the time of the sale and then forward it to the state government at regular intervals. In New York State, retailers collect tax from December, January, and February, and it's remitted to the state by March 20th. That's when the money and the sales tax return is due. And every 3 months that continues. When collected, sales tax is a current liability to the company that owes the tax. So in our example here, a television is sold for $1,000 cash plus 5% sales tax. To figure out the tax, we multiply 1,000 times 5%, and that's $50. So the company collects cash of $1,050, and we only put in the revenue account the sales price. the tax has to go into the liability account because that doesn't belong to the retailer. That belongs to the government. When it comes time to pay the state, we debit sales tax payable for the amount due and credit cash. So let's try a little problem with that. And this is Grandpa Clocks. It's a retailer of wall, mantle, and grandfather clocks. And they want us to assume that GCI sells a grandfather clock for $10,000 in cash plus a 4% sales tax. They didn't give us a date, so we won't bother with one there. But let's see. It says 10,000 plus 4%, and that sale is going to be in cash. So we're going to debit cash, and we're going to credit sales revenue for the amount of the sale, and then we're going to credit sales tax payable for the amount of the tax itself. Okay, well, we have to calculate the sales tax and add it to the revenue to figure out how much cash we're going to receive. So let's see. The grandfather clock selling price was $10,000, and to calculate the tax we multiply 10,000 times 4%, and that would be $400. So in all, the retailer should be collecting $10,400. Now, if it was a sale on account, instead of debiting cash, we would debit accounts receivable. But there's one more trick to this one. They say prepare the journal entries. That's plural, right? And they tell us to assume GCI uses a perpetual inventory system. Remember, when you've got a perpetual inventory system, you have to record the sale at selling price, which we did, but you also have to take out of inventory the cost of what's been sold. So we have a second journal entry here. This is a trip down memory lane to Chapter 6. A debit to cost of goods sold and a credit to the inventory account. And it said the clock originally cost GCI $6,000. So we'll debit the expense account, cost of goods sold, and we'll credit the inventory account. So what's the amount of gross profit GCI made on that sale? Well, remember, gross profit is sales revenue less cost of goods sold. And the very last current liability is deferred revenue. We're not going to do any problems with this, but if you recall, deferred revenue occurs when companies receive cash or receive payment before they have provided goods or services. Consequently, they owe their customers the goods or the service. We can't call it revenue until it's been earned, until the goods or services are provided. So we have to put it in deferred revenue, which is really a liability, meaning we owe the customer the goods or services. Once the goods or services are delivered, we do an adjusting entry, taking it out of deferred revenue and putting it into regular service revenue or sales revenue, depending on what the type of sale is, because it has been earned at that point. So that's the end of Learning Outcome 10-2. You can go to Connect and try some problems, or you can take a listen to the lecture on 10-3.